How many stocks must you purchase to earn $1,000 per month? The stock market's complex environment is the very first thing that springs to mind when you think about it. It's simple to become lost with so many perplexing charts. Everyone is aware that you may buy stocks and trade them anytime their value increases. But there is another strategy used by seasoned investors to generate enormous profits. Warren Buffett's 5 key assets generated $3.8 billion in cash in 2018. Do not misunderstand. He did not sell his shares in order to profit so greatly. However, these 5 businesses generated a significant amount of money throughout the year. These businesses were required to split their profits with Buffett because he is a stockholder in these businesses. That is what dividends are. Simply put, there are 2 types of companies that trade on the market. Those that have already reached maturity and have sustainable, profitable business models. As a result, whenever they make a profit, they are unsure of what to do with it and end up giving it to their shareholders. And those, like Tesla, that are still attempting to make a profit. The question we will attempt to answer in this video is how many stocks you must purchase or how much money you must invest in the stock market in order to receive $1,000 from your investments each month without selling your stocks. They may report a financial gain, but the company needs that money to grow even further. However, we must first comprehend a few crucial ideas. How do dividends operate? What dividend stocks are the best? And how can you prevent falling victim to the dividend trap, which could cause you to lose all of your money? Dividends have been the true passive income source since the dot-com bubble, when investing became more complex. Prior to that, investors' first priority was to fund businesses that would be profitable and distribute their earnings to them since they had a right to those gains as shareholders. But when business people like Jeff Bezos entered the picture, everything changed. The objective had changed from maximizing profits to expanding the business, even if it meant withholding all dividend payments to stockholders. The approach is to continue operating at a loss until you control the whole industry and then produce profit, as you will be the only player in the market. A company that only consumes cash and isn't profitable appears like a lousy business. And for the past 25 years, Amazon has operated in that way. Despite being valued at $1.6 trillion, it has never given its shareholders any dividends. In fact, because it was declaring a loss, it evaded taxes for 20 years. Amazon generated $11.5 billion in net income in 2019 compared to Walmart's $15.2 billion in revenue and $2.16 in dividends paid per share. But Walmart was still only worth a third of Amazon's overall value. Walmart appears to be a better choice if you seek passive income, even though Amazon may appear to be a more promising investment in the future. And there are numerous instances of this in the stock market. Only a small number of tech firms offer dividends. The remainder, notably the larger ones, would prefer to reinvest their profits rather than paying you. Let me know in the comments if you have any other questions about investing. Let's return to the video. High dividends as the ideal investor attraction scam. High dividend paying companies are quite alluring, but they aren't necessarily the best investment. In truth, dividends can be utilized to deceive investors and take advantage of them. The business can be barely surviving, or it might be on the edge of bankruptcy. Its stock is declining annually. Therefore, one strategy to attract investors is by paying out huge dividends. Consider UVV or Universal Corporation. Its dividend yield is 7.16%. As you can see if you look at it. The euphoria is unfathomable. That kind of product is probably not available in the entire economy. Even Apple, the biggest firm in the world, pays dividends at a rate of about 2%. However, I myself would not purchase this stock, and I would not suggest that anyone else do either. The stock price was around $50 5 years ago, so you might have expected that it might have increased slightly since then at least. Instead, the price dropped at $43. And even though the company appears to have a bright future, it pays higher returns to keep its stock appealing to investors, because you never know where the price of the stock will be in a few years. Compare that to Apple, which pays only 2% in dividends, but saw a 337% increase in stock price during the same time span. Although sacrificing your principal is unpleasant, cash flow is good. And there are plenty of these stocks on the stock market. Therefore, avoid buying a stock only because it has the greatest dividend yield. Are there any solid businesses that are expanding and offering dividends that are sufficiently high by this point? Yes, there are. Consider Coca-Cola, which has been around since 1886 and started paying dividends before you were even born. Its dividend yield is a respectable 3.2%. Because many people think there isn't much more room for Coca-Cola to grow, the stock price hasn't been increasing as much as certain tech companies, but it won't decrease the following day either. Another illustration is the Home Depot. A dividend payout ratio of 2.5% has consistently been paid by them. In the past 5 years, the stock price has doubled. Being in business since 1886, Johnson & Johnson is widely regarded as the king of dividends. It's a well-known brand in the pharmaceutical sector. It is crucial in the creation of the pandemic vaccine as well. Once the vaccine is ready, its stock price may experience a surge, since the theory behind it is that the firm will be far superior if it reinvests that money and grows faster. Tech companies are typically those who don't pay dividends. Investors adore Apple because it pays no dividends, unlike firms like Google, Facebook, and Tesla. It's a tech business that does both hardware and software as well. It has an ecosystem already in place that gives it steady financial flow. While its stock price increases as much as that of other IT firms, it also offers a dividend yield of about 2%. So let's attempt to respond to the question, how much investment is required to earn $1,000 each month? Since dividend yields vary from stock to stock, and we prefer not to invest in businesses that don't seem to perform well over the long term, companies like Apple, Coca-Cola, Johnson & Johnson, the Home Depot, and others that not only pay out big dividends, but also have the potential to develop over time will be considered. Since stock prices and dividend yields fluctuate annually, it is challenging to get a precise dividend yield. Additionally, it relies on the portfolio you create. But let's say that you'll obtain a yearly return of 2.5%. You have to invest roughly $500,000 to earn a passive income of $1,000, which will provide you $12,500 each year, or little more than $1,000 per month. And let's say you wish to earn enough in dividends to finish your retirement. In such a situation, you would need to invest at least $2 million in order to earn $50,000 every year. I imagine you're not impressed because, for instance, investing $500,000 in real estate would give you a lot bigger passive income than $12,500. Investors are therefore more focused on stock price than dividends. Amazon may not have paid any dividends, but during the past 5 years, its stock has increased by 522%. Investors in Amazon have benefited in ways dividend investors could only dream of. Does that imply that buying dividend-paying stocks is foolish? Actually, no. Making dividend stocks a part of your portfolio is a wise move if you have a sizable investment portfolio that is spread across a wide range of stocks. However, You must also take into account the fact that these equities are also rising. So if you utilize these dividends to purchase more of the company's shares, you will eventually wind up with a respectable investment. The Home Depot is a highly enticing investment because its stock price rose by 26% last year, and it handed out dividends of about 2.5%. In contrast, if you are just starting off with a tiny sum, such as a few $1,000s, you cannot afford to purchase a property to rent it out. So for some people, starting with dividend stocks may be an alternative to consider. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.